Andrew, thank you for joining us. So tell me, what is Homeley and how did the idea come about?
So thanks very much for having me. Homeley is Ireland's first rent-own home ownership platform. It came about through, I suppose, my own set of circumstances, a bit of pain on the mortgage application front. I, like a lot of people, left Ireland in 2011. Went over, did a master's over in London, got a job over there, and kind of settled down in London for 10 years. Came back with two small kids,
Okay.
5 and 2 at the time. So I had my hands full. And once I landed back in Ireland, I had a deposit saved up, and I realised, better go down to the bank and kick the tires and see how I was going to fund a home purchase. And basically was told, computer says no. I was technically self-employed by a UK company, kind of still transitioning over to Ireland, hadn't paid, PAYE, tax in Ireland for a couple of years beforehand. So I was kind of excluded, I suppose, from what you would expect to be a pretty standard product insofar as getting a mortgage. So that's kind of how I started thinking about, well, surely there's no way that this can be the way that everybody deals in these situations. Do I have to go and rent now for 2 or 3 or 4 years? And at the time, obviously, 2021, rents were increasing. They've obviously increased a huge amount since. So I really didn't want to be put in a position where I was wasting money on rent. Then kind of Homeley was born.
Okay. So take me through the broad strokes workings of it. Who is it for?
Yeah, so good question. So Homeley is for what we call the squeezed middle.
Okay.
These are, typically people who earn probably more than the social safety net allows them to earn. So they're not necessarily eligible for affordable housing or HAP or any of the other kind of government incentivized schemes that are there to kind of help people who need it. A lot of these people are, we call them kind of slightly quirky in terms of their application. They might have 1 or 2 blips or issues on their existing mortgage application that kind of exclude them from getting a mortgage.
Let's just go through those blips because it's interesting. So living abroad, blip.
Living abroad's a big one.
Yeah.
Would you believe divorce is another big one, getting more common in terms of our applicants. I think the big one really is deposit and lack thereof.
Yes.
So you could tick 9 of the 10 boxes required to get a mortgage, but in a situation where you don't have 20, 30, 40,000 euro to purchase the average 3-bed house in Ireland at the moment, you obviously can't do that.
So it's getting back to that squeeze thing. It's the cost of living crunch. They're in the rental market. They're paying a lot for rent, so just not able to get that big amount together.
Exactly. And I think average rent now in Ireland is over 2,000 euros a month. So in a situation where a 300,000 euro mortgage might cost 12 or 1,300 euros, there's a big delta now between how much rent is monthly and how much it could be if you potentially were in a position to be able to get a mortgage. So so kind of fast forward, we've had almost 5,000 applications over the last 18 months.
Okay.
Most of them are mortgage ready, I would say, eligible for a mortgage, except for 1 or 2 of the 10 issues, as I mentioned.
Okay.
One main kind of point that we always try and make sure up front is Homeley are for people who are on the path to getting mortgage ready. There are lots of issues that kind of exclude people probably from ever getting mortgages. We had obviously a pretty big crisis back in the day, and a huge amount of people's credit history has been impacted by a lot of those situations that people have gone through. So, the CCR, the credit report, credit check at the moment is a pretty impactful point when it comes to banks actually lending money on traditional mortgages.
Okay.
So if you can't, tick the box on that bit, it's very, very difficult for people to get mortgages right now. So we kind of aim to help that kind of forgotten middle, that squeezed middle, and actually just give them a bit of time. Because often, as you mentioned, if people are coming back from a foreign country, if they've worked abroad, self-employed, newly self-employed, trying to get their their accounts in order, pre-applying for a mortgage, that they don't want to wait those 3 or 4 years, just like I didn't want to wait those 3 or 4 years back a couple of years ago. So yeah, we say we kind of bridge the gap between rental and owning. And at the moment, the drought of suitable quality rental accommodation is really, really putting a squeeze on people at the moment. So it's becoming much more difficult to find something, even if you can afford it.
Yeah. Let's take the example of someone that we can all recognise, or that a person can recognise in themselves. So let's take somebody who is a separated parent, and the other parent is staying in the family home, and they then have to go off and get accommodation. So it's a real tricky area for a lot of people that they just can't see any way out of.
Yeah.
So they come to you and they want to buy an apartment, shall we say, for 400,000? Is that reasonable-ish?
Yeah,
a one bed? Yeah. Okay.
Yeah.
So tell me what the offer would be for them.
In that situation, we would look at that single applicant. We would assess their income, kind of similar to how a bank would. We would look at their affordability levels. We obviously don't want to put them in a position where they're financially strained on a monthly basis, even though we are their landlord technically for a set period of time. We really are looking at it to make sure that they will be mortgage eligible at the end of whatever period we sign up to, usually between 3 and 5 years. Just to be clear, if we don't think that they have a high chance of being mortgage ready for that property, even in a situation where they, may have the income, but, other issues, their disposable income at the end of the month might be low, we specifically tell them up front. So the other thing we tell them up front is if they can get a mortgage at that point in time, get it.
Okay.
This isn't instead of a mortgage or instead of renting. This is specifically for people who know that they are, have a very, very high likelihood of being mortgage ready at the end of the term, but just need a little bit of help to get there. So we would then, assess all of those pieces. If we thought that customer could afford the monthly payments on a €400,000 property, then we would kind of backtrack in. We would allow them to be able to, submit their application and work through it. And if they couldn't, we would say, well, look, maybe 400,000 is too much for you. Maybe that's too expensive monthly. Maybe look at 350 or 325 or. So there's a lot of back and forth with customers up front to make sure that they firstly understand the whole model and how it works, but also that we don't put them in a position where the monthly payments are crazy. Because we do get, as bad as it sounds, we do get a lot of people who are saying, no, don't worry, I'll find the money, I'll figure it out, I'll spend 50% of my net income monthly on property costs, don't worry, I promise. And we just, we don't want to be in a position at the end of the term where, something happens, they can't afford the property, they can't get a mortgage for the amount that they require in order to buy it off us at the end. So huge amount of considerations. The other thing, again, one thing we opened up last year for single occupants and single applicants was the ability to rent a room. Mm-hmm. So if they want to subsidise their own costs by actually renting out a room, so instead of the one bed, maybe it's a 2 bed, and maybe a little bit further out, so it's less than 400k, we're okay with that as well. So
okay, got it.
Along with acting like it's your own home from day one, painting the walls, getting a pet, hanging pictures, not being worried about putting a hole in the wall. We also are totally happy with people renting out a room if they wish.
Okay, let's just go back there. So it's 2.5% of the purchase price down from the get-go.
Yeah.
And then after that, they pay you a rent which is based on the current market.
Yeah. So exactly. So 2.5% of the initial value of the property, subject to a minimum of €10,000. And for that, they sign 2 agreements: an RTB registered tenancy agreement at market rent, as you say. So again, we have to charge market rent. And then in addition to that, monthly, they pay what's called a purchase option payment on foot of their purchase option agreement.
Okay.
So that can range, again, subject to applicants. Some people want to pay more because more, 20% of a bigger number is a bigger discount at the end. Some people want to pay less. Some people want to stagger the amount of that over certain years. So we can be pretty flexible with that payment. Continuing to pay that amount monthly keeps their purchase right at the end of the program open and live. So in a situation where somebody pays €2,000 a month in monthly payments, maybe 400 of that is the option payment, 1,600 is rent. So the accumulative kind of 20% of all the payments they pay us over the term equates to, roughly 400 multiplied by the term, 36 months or 60 months.
Okay, got it. So when you're saying 20% there, they get 20% back.
Exactly.
At the end. So 20% of total rent payments.
Total payments and
payments,
total,
got
yeah,
it.
exactly.
Okay.
So not just of the rent. So
okay.
Yes, you pay a little bit more. You get, secure tenancy rights. So, at no point can we kind of evict you over that period of time, between 3 and 5 years, whatever the program period is. That's it. You're in. And again, as I said, you can operate the property as if it's your own from day one.
Mm-hmm.
And yeah, so then at the end, when you kind of fast forward all the way to the end of it, 99% of circumstances, our customers will get a traditional mortgage. They'll get a normal open market mortgage from Bank of Ireland or AIB. And at that point, that bank will require a valuation.
Mm-hmm.
And in order to just keep it very transparent and easy to manage, we use the valuation that their mortgage provider has provided them with on foot of their application for a mortgage. So that becomes the purchase price. And then we talked about the 20%. So that 20%, could be 15,000, 20,000, whatever amount that is after that period. That gets deducted from that value at the end.
Mm-hmm.
And then separately, but in addition, they also get up to 20% of the value increase over the period off that purchase price.
Okay.
So I've said a lot there, so maybe back up for a minute. The whole concept of Homeley is designed around the discount, the combination of both of those figures, to equate to somewhere between 8 and 12% of the then market value of the property.
Okay.
So that amount then can be presented to the bank as kind of evidence as your deposit.
Okay, got it. But this is minus the 2.5% down payment of sorts at the beginning.
Yeah, so that, how we call it, that initial 2.5% forms part of their option payments.
Mm-hmm.
So how we usually describe it is everything you pay us over
mm-hmm.
the whole term, you get 20% of that back off the end.
Mm-hmm. Okay, got it. What happens if the property price falls rather than rises?
Yeah, so we do have a specific price at which the property needs to be purchased at the end. Unfortunately, we're not government supported, not yet anyway. And the main thing for us is to make sure that obviously the model is viable and that people understand what they're getting into from day one. If the property price halved, for example, I think we both have an issue. Obviously, we own the property, which is worth half of
mm-hmm.
what we bought it for. And obviously the customer then, which we obviously see as a big positive, technically can hand us back the keys. So it's kind of a one-way option agreement. We can't force that customer to ever purchase the house, whereas the customer obviously can force us to buy the house. So yeah, there's lots of little dynamics within the model, but if the house halved, technically the customer hand us back the keys and buy the house across the road for 50% less.
Mm. So I guess there's a little bit of poker in it, because we don't know what way the property market's going, realistically.
Yeah. I suppose the thing to remember as well is that, there's probably a little bit of poker in a normal house purchase as well.
This is it.
Yeah. No, and again, agreed. I think the main thing is all the various different elements. Like we have 550,000 under 37-year-olds living at home right now.
Yes.
We've lots of people trying to save as fast and as quickly as they can, chasing a market that is increasing faster than they can save the 10%. We've people sacrificing life milestones left, right, and centre: babies, marriages, holidays, just to try and get their foot on the property ladder. So, look, again, I think Homeley, as I mentioned, is for people who maybe are renting a home or a property that is expensive for what they need, for what they want, from where they want it. And Homeley, for some, offers a bit of a window and a gap to be able to purchase something on the open market that they want and need, and is maybe within the community that they've grown up in. So yeah, look, like everything, there's considerations.
Yes, yeah. Who have you rejected?
Oh God, yeah.
No. So, I'm curious, who doesn't make the cut?
Anyone who we see And it's pretty clear, I would imagine, when you look at most people's kind of circumstances or financial situations, even by, talking to people, it's relatively clear quickly that we just, think they're overshooting the mark with regards to their salary versus what they want to buy and when. Often we don't reject people based on their own circumstances. We reject based on their expectations.
Okay.
So it's, kind of agony aunt as well in a lot of situations, because we get people from all walks of life, trying to buy something, maybe that they're kind of stretched for, or then the opposite. We've people, absolutely cutting their cloth and saying, look, I just want a starter home. A lot of big term at the moment is starter home. I just want to get on the ladder in some description. And, they might have a good salary at the moment. They might have good expectations with regards to salary increase over the next 3 or 4 years. Like the most interesting conversations we have are kind of with, grads, 23, 24, 25, all on like pretty good career trajectory. They know that, if things going well and they tick all the boxes and do everything right, they're going to be on, 20, 30% more in 5 years.
Mm-hmm.
And those are the people paying €1,000 a month in a bedsit in Ranelagh.
Yes.
So they don't have the cash. They don't have the, they don't have the savings. They don't have the track record. They might be in work a year or two.
Mm-hmm.
And their option is either extortionate subpar rental.
Yes.
Close to where they, close to town or whatever, or unfortunately, their parents' house.
That's the part that sells it to me. It's the kind of agency piece for me. It's the having the right to put your mark on a property.
Yeah.
Or to have a dog, to have a cat, to, as you said, to rent out a room if you wanted to, because and that's 14,000 a year tax free.
Absolutely.
So it's like just a few little things that you cannot do in a traditional rental situation. Yeah,
and it is very different. And I have to say, I'd like to claim credit for it, but we didn't invent the model. This has been tested across the world. We've adapted it to an Irish context, Irish legislative system, and also kind of a very Irish problem. I think, we want to make sure that we as a business are incentivized as well to ensure that the customer can buy the property at the end. So, to your question, what happens if the house, halves in value? In reality, what we would probably do is just extend the term, extend the term out, either go back to let them rent. We don't want to be in a position where we have to sell a property at the end of a term as well. So there are different nuances, as I say, to all of these situations, but we want to make sure, the whole mission of the business is to get people owning homes. And, we don't want to be in a position where we've bought, in a very rural location with the maybe higher default chance, or we've taken a punt on a kind of maybe a slightly tougher customer.
Where in the world, Andrew, is this particularly popular? Like the rent to buy as an alternative form of getting on the property ladder? Yeah,
so pretty much every Western democracy has some form of this. In Spain, for example, it's actually written into the legislation that tenants get the right to purchase at the end of a set period of time. So, our view is let's do that. Let's look at the government. Let's have a chat. Let's discuss this. Let's figure out a way of legislating for rent own in either the way that we've come up with it for an Irish context or something different. We're totally open to flexibility and different models and innovation in the housing sector. So, we don't mind what it looks like. The main thing is that if there was, like the UK, for example, it's a co-ownership or shared ownership. It's a well-trodden path in the UK. You go up to Belfast, obviously it's the same thing. So yeah, we kind of look at the UK as a pretty good model as to how we think we could work here. And the only thing that does is it makes it cheaper for customers. Because if Homeley doesn't have to be a solely private market operator with private market required returns and capital costs and all of those things that come with a private business, if it was more legislated for within the government and a specific scheme, all that would happen is that those required returns would fall, because it would be kind of easier to operate. And the net beneficiary of that is the underlying customers. So instead of, our kind of, maybe we could charge less than market rent. Maybe we could incorporate HAP payments into our Homeley. So,
So these are conversations that you're having.
Yeah, absolutely. I mean, there's 700 odd million euros annually going into HAP payments. Our biggest issue with HAP is that banks don't necessarily look at HAP as income by virtue of their affordability calculation when a mortgage application comes along. So what about weaning people off HAP? Because all of a sudden you get addicted to, 9,000 euro, or 8,900 to 1,000 euro of HAP contributions onto your average 2-bed apartment. Then, you're instead of looking for a traditional mortgage and, trying to get your way out of HAP, you kind of, they tend not to. They, go on a social housing waiting list or something else. So there's lots of money being pumped into this issue at the moment. And our kind of worry sometimes is, well, could it be better spent? And how we could incorporate rent to own within the wider ecosystem of the different tenant mix: affordable, social, rent to own, HAP, PRS.
Yeah. Yeah. If you were housing minister, what key changes would you make to solve the Irish housing crisis?
That's a tough one. That's a really tough one. Look, I think there's a lot written at the moment about, silver bullet, what would help. I think probably a couple of sections you'd look into. One is supply immediately. I think one of the big ones we've been pushing for a while is cutting VAT, like fully, as opposed to marginally, but cutting VAT fully within certain confines. Stuff, houses that are units that can be built today. There's quite a lot of land out there at the moment that is sitting idle, full planning permission, and it's just not viable. So potentially helping free up that, I think, just as something to do immediately would help massively. Viability, planning. There's a lot to be talked about planning at the moment, and how the risk of going through that whole planning process and the costs and liability incurred by developers. Profit is a bad word in Ireland when it comes to property. We've obviously been burned a few times by the property developer thesis, but I think the other thing that we can do is we can look at, clearly I would say this, but innovative housing models. Obviously rent to own being one of them. Maybe somewhat more innovative mortgage products at the moment. Clearly Ireland, we just don't have a huge amount of mortgage providers, but there's a reason for that. So I think it's a very broad question. I think supply, obviously, need to put the foot down, demand, and also innovation to kind of help on the demand side in a situation where we have a whole generation now of people locked out of home ownership. I was reading last week that the net worth of the average person in Ireland that owns a home is just over 350,000 euro net. The same figure for a renter in Ireland is 5,000 euro.
Wow.
So, this is it's homes and it's shelter and it's over our heads. We have financialized, for better or for worse, we have financialized home ownership and housing over the last 20, 30, 40, 50 years. And, we're currently in Ireland, I believe, sitting on 150 billion worth of cash piles. Interestingly, the people that have lots of cash are also probably the people who have lots of property. And that is a big issue, because there's a big difference between the haves and the have-nots at the moment in Ireland.
It's getting wider,
Yeah.
sure. Andrew Lynch of Homeley, thank you so much for joining me.